Tesla is an exciting company, and it has an exciting stock, but sometimes too exciting.
Why don't you just keep calm?
Barron's recently suggested that investors consider buying Deere, which it called the Tesla of farming. So what does that mean? Most people don't associate farming with tech, but it's time they should. Technological innovations in farming are making it easier and cheaper to produce agricultural commodities such as wheat, corn, and soy, and Deere appears to be leading the way. Recently, Deere unveiled a self-driving tractor at the Consumer Electronics Show in Las Vegas. It was one of the few times that farm equipment packed way more wow than the latest smart TV or gaming device. While it may be years until we see self-driving cars on highways, self-driving tractors are more likely to be put to use soon. That's because it's easier to program tractors. They operate at low speeds in predefined spaces with fewer obstacles than a busy highway. The upgrade cycle for farmers to switch to the new tractors is reason to be bullish on Deere shares, especially since the software running the tractors could be subscription-based. But even before they stole the show at CES, my colleague Jacob Sonnenschein was bullish on Deere. Jacob is a markets reporter at Barron's who also loves stock picking. Back in December, Jacob wrote that sustained inflation could help Deere.
This company is the perfect company to own in an inflationary environment. Its costs are rising a little bit, as are many companies' costs, but Deere specifically can raise prices to offset those cost increases and keep its earnings growing. Spoke to an analyst recently. It's raising prices by about 7 to 8% year over year, and that's going to keep earnings growing in the mid-teens in percentage terms over the next couple of years. So the stock can probably go up in line with that, maybe even more, because the price of the stock is not necessarily reflecting that earnings stream because it's priced a little bit cheaply to its 5-year history.
Some may think that if inflation runs too hot, Deere won't be able to pass on higher prices to customers. But farming is an incredibly competitive business, so customers may be willing to absorb some of the higher costs if they come with the promise of greater efficiency. A self-driving tractor can run at all hours, saving time and labor, and it can improve productivity by as much as 20%. But at the time Jacob recommended Deere, the stock wasn't pricing in that particular growth opportunity.
Deere is trading below its 5-year average on a forward earnings multiple basis because it's a cyclical stock. It is economically sensitive, and a lot of cyclical stocks recently have been discarded a little bit by investors in the last 6 to 8 months or so because the surge in economic demand that we saw in 2021, it's going to slow down in the next few years. And so cyclical stocks have not been the best performers in the U.S. stock market. Deere is pretty economically sensitive, but it's actually a really quality company. It's very competitive in its business. It's a big company with a lot of cash and can always invest in the right products and therefore can raise prices, keep those earnings growing, and therefore edge out some of the other cyclical stocks where Deere can perform very nicely.
While Deere's evolution is exciting, so is the outlook for agriculture in general. Recently, the USDA projected that total 2021 U.S. crop receipts will be up 19.7% from the 2020 levels, while livestock receipts are expected to grow 16%. The industry is expected to stay strong in 2022. Deere will be a company to watch this year.